Welcome to our discussion on principles of economics, and we were discussing about some important applications of the economic principles that we have learned in all those chapters. So these principles, these applications will help you understand how economic principle can be used in empirical, in applied works, right? So yesterday we discussed last 2 days we discussed so many problems, and then again today we will be discussing some more problems. These problems cover all the chapters that we have learned in our micro and macro modules. So the first problem again is, the question is, lead is an important input in the production of crystal. Now if the price of lead decreases, then all else equal, what would we expect? Okay. So that means when the input price decreases, what happens? That is the question. So the first option is the supply of crystal to be unaffected. Naturally, you can understand, when the input price decreases, the supply of the end product cannot be unaffected, right? Something will happen to that final product, either it will increase or decrease. What will happen? That we have to find out. The supply of crystal to decrease. Now when the lead price decreases, what happens is cost of production for crystal also decreases, and if that is the case, supply of crystal cannot decrease, right, when the cost of production decreases. So the supply of crystal has to rise. So the third option seems appropriate. Now let us see the supply of lead to increase. The fourth option is, see, if you recall in yesterday's class we said that demand for input is actually derived demand. So lead as such does not have any direct demand. Demand for this lead is actually derived from the demand for crystal. So obviously when the price of lead decreases, the supply cannot increase, because supply is a upward sloping, and it cannot increase when the price of the product is decreasing. So obviously then the option would be the third one, the supply of crystal will increase. Then what do economists illustrate when they use the phrase called, there is no such thing as a free lunch? Okay, there is no free lunch in economics. What do they mean? How inflation increases the price? Do economists they mean this by free lunch? No. That to get one thing we must give up something. Okay. No seller can offer you some free gift with a purchase of something else, that if something looks too good to be true, it is probably false. So actually the correct option is the B. To get one thing we must give up something. So that means in this world, that is why we say there is nothing called free. Everything comes with some amount of opportunity cost. Since resource is limited, we have unlimited demand. We cannot get everything what we want with our limited resources. If we want to get something, then we must sacrifice something else in return, and that is why economists they mean that there is no free lunch. That is the meaning of this word. Question number 3. Comparing the short run and long run profit maximizing positions of a perfectly competitive firm, which one of the following statement is true? Price will equal to marginal cost in the short run, but not necessarily in the long run. Is this true? So P equals to marginal cost, P equals to MC in the short run but not necessarily in the long run. Economic profit may exist in the short run and in the long run both. The firm will produce at a minimum average cost in both short run and long run. Price should equals to average cost in the long run, but not necessarily in the short run. Okay? All these are related to perfectly competitive market, and let us try to understand. First one, price will equal to marginal cost in the short run, but not necessarily in the long run. As I said that look at this long run equilibrium, this is P and C. The long run equilibrium is what we have discussed, this let us say this is AC, this is MC and this is P. So, P equals to MC equals to LAC, P equals to MC equals to LAC. And this is actually LMC. So, that means price equals to marginal cost in the short run, also in the long run. So, that means this is not true. Price marginal cost pricing is the rule of a perfectly competitive market that I said. That is true for both short run in the long run. Economic profit may exist in the short run and in the long run. If you look at P equals to LAC equals to LMC, so that means what is, how do we calculate economic profit? P minus AC into Q, that is how we have defined profit, the difference between P and AC. So, if P becomes LAC, then obviously that becomes 0. So, the economic profit in the long run is 0. So, that is why economic profit exists in the short run and in the long run, that is also false. In the long run there is no economic profit, this is 0 actually, 0 economic profit because this is 0. The firm will produce at minimum average cost in both the short and long run, minimum of average cost, both in the short and in the long run. That is also not true. Price should equals to the average cost in the long run, but not necessarily in the short run. That is the condition. Because short run equilibrium of a perfectly competitive firm, this is the demand. Let us say this is MC, this is MR, this is P equals to MR equals to AR, that is what we said. So, that means this is equilibrium. Okay? And generally we do not know if the profit maximizing firm, generally in the short run what happens is price is actually equals to, is more than the average cost. So, it happens in this way. So, the difference between this is the, so price is not necessarily equals to the average cost in the short run, but only in the long run. That is the true option for a perfectly competitive market, we have to keep in mind. So, marginal cost pricing is the rule for a competitive firm, whether it is a short run or in the long run, that must happen. But the long run equilibrium differentiate with the short run is that price is not only equals to the marginal cost, but also is equals to the average cost. This is long run average cost, this is long run marginal cost, LAC and LMC. So, P equals to LAC equals to MAC, this is the long run equilibrium. But in the short run, price is still equals to MAC, this is MC, but not necessarily with the LAC. Then the next question, question number 4, is about positive and normative statement. If you recall that in one of our previous, when we started our discussion, we said that economics is basically divided into two: positive economics and normative economics. Positive economics just explain the world, okay, what happens, and normative economics comes with some kind of policy prescription. So, if a statement is given and if you are asked whether it is a positive or normative statement, then how do you differentiate these two? Then you must say that, you must think whether the particular statement is describing the world or it is suggesting something. Okay? So, normative statement generally comes with it should be done in this way. So, with a policy prescription, with a value judgment, but normative statement, but positive statement is free of any value judgment. There should not be. So, first statement: price rises when government prints too much of money. So, this is a positive statement. So, I am not suggesting any policy prescription. I am not saying whether government should print too much of money or not. So, this is just an explanation of the world around us. So, this is a positive statement. If welfare payment increases, the world will be a better place. So, welfare payment increases, the world would be a better place. See here, I am attaching some kind of value, because I am not sure whether welfare payment will be really make the world a better place or not, because where will the welfare payment come from? Who will pay for this? Who will be better off? Who will be worse off? That I do not know. So, that is why it is some kind of value judgment. Some economists may suggest this, but that needs to be proved. Okay. So, normative statement can be proved or disproved. Inflation is more harmful to an economy than unemployment. This is also another statement with value judgment, because it depends on the context, whether inflation is more harmful than unemployment. There is no economic theory, this is not explaining the world. Economic benefits of improved equity are greater than the cost of reduced efficiency. So, that also it's come with a value judgment. It may or may not be true always. So, one thing which is clearly explaining the world without any value judgment is this: prices rise when government prints too much of money. That is already proved. There is no value judgment attached with it, right? If question number 5, if Mexican laborer is less productive than that in the United States in production of all commodities, which of the following is correct? Neither nation can benefit from trade. Mexico can benefit from trade, but the United States cannot. Mexico will not have a comparative advantage in any good. Both nations can benefit from trade. This is an interesting example. See, Mexican laborer is less productive than in the United States. Let us say there are two commodities. Computer and wheat. There are two commodities produced by both Mexico and the United States. And production of both wheat and wheat and computer requires less amount of labor for the United States. So, therefore, we can say that Mexican laborers, they are less productive, because Mexican laborer, more labor is required to produce computer and wheat in the context of the United in the context of Mexico. So, that means from this we can understand, since Mexican laborer is less productive for both the commodities, that means the US has absolute advantage in producing both computer and wheat in both the products. But if you recall, in one of our examples, we learned that even if a particular country has absolute advantage in both the products, okay, it is still possible that they are having comparative advantage. It is possible. Okay. And benefit of trade is actually based on comparative advantage. So, even though United States have absolute advantage in producing both, it is possible that Mexico also has comparative advantage in some of the goods. Therefore, neither nation can benefit from trade is not true. Mexico can benefit from trade, but United States cannot. That is also not true, because if only one party is better off, the other is not, trade will not happen. Mexico will not have a comparative advantage in any of the good, that is also not true. Both nations can benefit from trade, that is true. You can take some examples and understand. Okay? You can take some examples. For example, let us say United States require, there are two commodities, computer and wheat. To produce one computer, let us say United States require 100 amount of labor. To produce one bag of wheat, it requires 15 hours of labor. This is for the United States. If you take Mexico, it may so happen that producing one computer requires 150 hours of labor, wheat requires 15 hours of labor. This is hours. So, from this structure we can easily understand that US has absolute advantage in both the commodities, because US requires less amount of labor for both. But if you calculate comparative advantage, okay, comparative advantage, what is the opportunity cost of computer in terms of wheat in the US? Opportunity cost of computer in the context of with respect to wheat. Okay. So, that means let us say uh, a given amount of labor, if you can calculate from this structure, you can easily understand that opportunity cost of computer is less in the US compared to Mexico. Okay. So, that means even though the country has absolute advantage in both, the country still has comparative advantage in one of the product, right. And therefore, the basis for trade can always be the comparative advantage, not the absolute advantage one. Okay. Then come to the next example. Which of the following is a component of M1 money supply in India? Government bonds, demand deposit, saving deposit, travelers check. So, M1 is basically the demand deposit that we have studied from money supply. What does CPI basically measure? If you recall, CPI is consumer price index. The overall price of inputs purchased by a typical producer, the overall price of goods and services bought by a typical consumer, the overall price of goods and services produced in the economy, the overall price of stocks on the Bombay Stock Exchange. So, consumer price index, if you recall, we discussed in the context of standard of living, it is a measure, it is used to measure inflation, and we said that consumer price index is the first step of calculating inflation. What is the idea? The idea is to fix a basket of commodities. There are many items there in this basket. This basket covers goods as well as services like rice, like dal, rice oil, vegetables, housing, clothing, medicines, everything. So, this is basically a basket for a typical or representative consumer, please keep in mind. Okay, Labor Bureau of Statistics, what they do, they fix a basket which a typical consumers they buy on a day to day basis, then they try to calculate the cost of that basket in two different periods. If there is a, and that cost is, that means a price index, they calculate the price of that basket, a price index of that basket, and that is CPI, price of this entire basket. And if that goes up over a period of time, then we say that there is a growth in consumer price index, and that is why there is inflation. So, therefore, the overall price of goods and services bought by a typical consumer, that is the idea, not the typical producer. Okay. Which of the following is a characteristic of a perfectly competitive market? Firms are price setters? No, that is not true. In a perfectly competitive market, what we learn, that firms, they do not have any control over prices, rather firms are price takers. There are few sellers in the market? No, that is also not true. There are n number of sellers in the market, n number of buyers also. Firms can exit and enter the market freely, all of this. So, obviously, this is the answer. Firms can exit and enter the market freely. Okay. Then question number 9. In a perfectly competitive market, the process of entry or exit ends when firms are operating with excess capacity. Okay. So, firms are operating with excess capacity. Is that the in a perfectly competitive market, the process of entry or exit ends, the firms are operating with excess capacity? That is not the characteristics of a competitive market itself. Excess capacity is there, if you recall, in the context of a monopolistically competitive market, but not in a perfectly competitive market. Firms are making zero economic profit. Firms experience decreasing marginal revenue. Price is equals to marginal cost. price is always equals to marginal cost, but that does not ensure that entry exit will end. So, entry and exit will end, as I would like to draw the diagram again. That means when the entry and exit ends, that situation is actually a long run equilibrium situation, as I said. LAC, this is MC, so this is your price. So, P equals to LAC equals to LMC, this is the condition, and then economic profit is actually 0. That is the condition. So, this equilibrium condition is when P equals to LAC equals to LMC means economic profit is 0, but accounting profit is still positive, that you have to keep in mind. So, that is why we said that in the long run equilibrium of a competitive market, economic profit is 0, but accounting profit could be still positive, and therefore, there would be firms in the long run as well. Which of the following tool is used to control money supply by RBI? Open market operations, real interest rate, government expenditure multiplier, excess reserve. So, we know this is open market operation. What does the RBI do through open market operation? If the RBI wants to increase money supply, then RBI will buy some of the government bonds. So, if the RBI wants to buy, that means RBI has to buy against money. So, money will flow from RBI to the economy. So, money supply will increase. If RBI wants to reduce money supply, then RBI should sell more government bonds. Consumers will buy those bonds against money. So, money will flow from the public or individuals to the RBI. This is we have discussed earlier in economics. The central problem is allocation, consumption, scarcity and money. So, it is about scarcity, that is the central problem, not the allocation, because allocation or rather efficient allocation matters when you have resource scarcity. If resource is abundant, then there is no question of allocation. Consumption, yes, it is important, but that is not the central problem. Money is also not the central problem. Then minimum percentage of deposits that a depository institution must hold and cannot use for lending is known as, you may recall that when some amount of money is deposited in bank, then bank keeps some amount of reserve in its vault and remaining only used for loan purposes, and that is known as required or cash reserve ratio, CRR, cash reserve ratio, okay, or required reserve ratio. If 100 rupees is deposited and CRR is 10%, that means out of 100 rupees deposited, if this is 100, 10 would be kept as CRR, then 90 rupees would be used for loan purpose. Okay. Equilibrium quantity in an oligopoly market is lower than that of monopoly, but higher than competitive market. Lower than that of monopoly, but and in competitive market. Higher than both monopoly and competitive market. Higher than that of monopoly, but lower than that of competitive market. See, equilibrium quantity, that means supply, depends on number of firms in the market. In perfectly competitive market, firm is price taker, number of firm is infinite, and therefore, as we have mentioned earlier, perfectly competitive market maximizes social welfare, and supply quantity, equilibrium quantity is the maximum in competitive market. Now, oligopoly is in between monopoly and competition. Number of firms are higher than monopoly but lower than competitive market. So, obviously, quantity, equilibrium quantity would be more than monopoly definitely, because monopoly means only one firm, complete control, price is the highest, price is the maximum. So, supply would be higher than monopoly but obviously lower than competitive market. Because competitive market, the rule is P equals to MC, there is no market power. Okay? The moment P is greater than MC, supply will come down. And in monopoly, the supply is the minimum, price is the maximum. In oligopoly, price is more than monopoly, supply is more than monopoly, quantity supply, but obviously less than that of a competitive equilibrium. Deadweight loss is the loss incurred by the consumers only, producers only, either consumer or producer or both consumer or producer, deadweight loss. Now, deadweight loss is a situation you can think of. Let us say this is price and this is quantity, this is demand, this is supply, Q star, P star. So, before let us say taxation, this entire amount is consumer surplus, this entire amount is producer surplus. But when the tax is imposed, price paid by the buyer will increase, this is PB, price paid by the seller will decrease, this is PS. So, it will create some kind of tax revenue for the government. So, this is the vertical distance PB minus PS is basically the tax. So, what is happening? Now, the consumer surplus is only this area. So, there is a loss by this area, let us say this is called A. This is a consumer surplus loss, and there is a loss in producer surplus as well, which is not going to the government's pocket, which is this. So, deadweight loss, how we have defined? The loss in consumer surplus which is not going to government's pocket. So, total loss is actually this area, if you take total loss, but out of which this area is going to the government's pocket. So, this area is not. Similarly, for the producer, this area of the total loss in producer surplus is going to government's pocket, this area is not. So, this is loss in PS, this is loss in CS, and loss in CS plus PS is the deadweight loss. Therefore, deadweight loss is a loss incurred by both consumers and producers. Then question number 16, if a product's income elasticity of demand is minus 1.7, then we can conclude that an increase in income will lead to an increase in demand for the product. The product is certainly a luxury good. The product is an inferior good, both A and C. So, since income elasticity is negative, with the increase in income, demand for the products cannot increase. First option is not possible. The product is certainly a luxury good. See, luxury good, for luxury good, income elasticity has to be positive, as I defined earlier, it should be positive. Then depending on if it is positive and less than 1. So, if EI is less than 1 but greater than 0, then this is called necessary. If it is greater than 1, if EI is greater than 1, then only there is a possibility that this is luxury. Income elasticity should be greater than 1. Okay? So, we should write like this: income elasticity, that means this is EI, this is greater than 0 and it is greater than 1 as well. Sorry, this is 1, let us say this is 0. So, income elasticity should not only be positive, but also greater than 1, then only we can say that the good product is luxury. So, this is an inferior good, that should be the answer. The marginal revenue for a monopolist rise as the monopolist sells more. Now, marginal revenue for a monopolist rises as the monopolist sells more. Look at this marginal monopolist, this is Q, this is P, this is the demand, and this is, we will learn that this is MR. So, that means since downward sloping demand, MR is also downward sloping and twice steeper than the demand. Let us say this is the MC. So, this is Q star and this is P star. Sorry. So, if you want to sell more, possibly, so what we have to do, then you have to lower the price. Monopolists must lower the price, and if you lower the price, since this is downward sloping, marginal revenue cannot increase actually. Okay, marginal revenue cannot increase. Is smaller than the price, MR less than P, that is also not true. Since the MR is downward sloping, P is always greater than MR. So, is smaller than the price, yes, that is true. Is negative when the monopolist demand is inelastic, that is also not true, because the relationship between MR, P and the price, if you recall, MR equals to P into 1 minus 1 by E. So, if E is when demand is inelastic less than 1, yes, that is also true. If it is inelastic, that means this is less than 1, MR would be negative. So, this is also true. So, that means the answer should be both B and C actually. For a monopolist, price is MR is less than P, marginal revenue is smaller than the price, that is also true. It is negative when the monopolist demand is inelastic. So, that means in this region, lower portion, when E is less than 1, from this relationship MR equals to what we have learned earlier, MR equals to P into 1 minus 1 by E. Now, you put E is less than 1, you will get MR negative. So, that is why the answer is both B and C. An equilibrium price is the market clearing price, is determined by the forces of demand and supply, the price above which a surplus will result, all of the above. So, equilibrium price, this is demand, this is supply, this is equilibrium price and quantity. So, what is happening here? That means at this equilibrium price is also known as market clearing. See, there is neither excess supply nor excess demand. Whatever the buyers wants to buy, sellers are supplying exactly same amount. And it is determined by market forces, demand and supply. These are the two market forces. The price above which a surplus will result. So, if you take any price above the equilibrium, see the supply is more than the demand. So, there would be excess supply. So, any price above the equilibrium price will result in excess supply. So, answer should be all of the above, an equilibrium price. If the marginal product of the last labor employed in a firm is 40 units of output, so that means the information given is MPL is 40, wage rate is 20, marginal product of the last machine, that which is marginal product of machine is MPK, which is 120, and the rental is 30. Okay. So, then the firm, is it maximizing output? If you recall that maximizing output requires this condition. What is the condition? This is, let us say, capital, and this is capital, this is labor. Let us say this is the iso cost line, this is the iso quant line, and this is equilibrium L star and K star. So, the equilibrium condition that we have learned is MPL by MPK, which is the slope of the isoquant, should be equals to minus W by R. So, I am not putting minus over here. So, this is the condition, MPL by MPK equals to W by R. Okay. So, that means MPL by W should be MPK by R, that is the, this implies this is the equilibrium, and we said that if this is greater than this, so that means if there is inequality, let us say MPL by W and this is MPK by R. What is the meaning of this? MPL by W is basically, what is W? W is the wage rate. So, that means if you spend W amount of money, you will get MPL amount of output. So, by spending 1 rupee on labor, you will get MPL by W amount of output. Similarly, by spending 1 rupee on capital, you will get MPK by W. So, depending on which is more than what, the producer will spend the last unit of money on either capital or labor depending on the return. Look at the information given, MPL is 40, W is 20. So, you put 40 and 20 here. This is 120 and this is 30. So, obviously, we can see that this is 2, this is 4. So, this is greater than this. So, that means the producer should actually employ more capital. So, should employ more machines to maximize. That means, since this is inequality, it is not maximizing profit, maximizing output. The firm is not at all maximizing output. Should employ more labor? No, because this return is more. Should employ more machines to maximize output in the long run. Then how will you get equilibrium? Once again, if you employ more machine, then marginal product of capital will go down, because marginal product is positive but diminishing, then again you will get equilibrium after some point of time. That is the idea. So, we need to find out MPL by W and MPK by R. This is coming from the equilibrium condition, that at equilibrium slope of the isoquant is equals to slope of the isocost. MPL by MPK equals to W by R. In a prisoner's dilemma, each player has a dominant strategy. The players are not in Nash equilibrium. The players cannot do better by cooperating, all of the above. So, here if you recall, in prisoner's dilemma what we learned, that each player has a dominant strategy, and the dominant strategy is non-cooperation, and the equilibrium condition is suboptimal. These are the three conditions we learned. That means suboptimal means what? Had they cooperated, their payoff would have been better than what they are getting now. So, therefore, each player has a dominant strategy. That is the condition for prisoner's dilemma. Without a dominant strategy, we cannot call a game as prisoner's dilemma. That is one condition. Each player must have dominant strategy. The dominant strategy is in non-cooperation. That means the players can do better by cooperation. So, this is also not true. And the players are not in Nash equilibrium, that is also not true, because in all dominant strategy equilibrium are Nash equilibrium. That also we said. Because in Nash was the person, John Nash came up with the idea of equilibrium itself. So, in game we can have only one type of equilibrium, that is Nash equilibrium. So, all dominant strategy equilibrium are Nash equilibrium, but all Nash equilibrium may not necessarily be dominant strategy. That depends on whether that is a dominant strategy or not. There is no guarantee that every time players will have dominant strategy, and both of them. Suppose a perfectly competitive firm minimum average variable cost is $3 when it produces 50 units of output. If the price is $2 and the firm's marginal cost is also $2, the firm should continue to produce, continue to operate, but to determine the amount of production needs more information than is given. The firm should shut down, right? Now, here if you recall, for shutdown condition, how do you decide whether to shut down or not? Basically, what is the benefit of shutdown? Benefit, if you shut down, you can avoid the average variable cost. So, that means the variable cost you can avoid, variable cost, because fixed cost, so anyway you have to pay. What is the cost of shutdown? The total revenue that you are going to lose. So, that means the firm will shut down when the variable cost or benefit is greater than cost, and if you divide both sides by Q, then what will happen? AVC average variable cost is greater than TR divided by Q is actually P, because TR is nothing but P into Q. So, this is the condition for shutdown. That means, if you recall, we said that the supply function is actually the upward sloping MC curve starting from the minimum point of AVC, if you recall. So, what is the supply function we discussed for a competitive firm? So, this is, let us say, AVC, this is MC. So, it starts from the minimum point. So, price must be at least minimum of AVC. Price should be equals to AVC. If price is less than even AVC, then that is the shutdown condition we discussed. Now, see what is happening here. Price equals to $2, but average variable cost AVC is $3. So, that means P is actually $2 here, AVC is $3. What should the firm do? Look at here. Price is less than ABC, this condition is satisfied, firm should shut down. There is a twist in this question. See, AVC and MC both are equal. AVC, MC, sorry, price and MC they are equal. So, P equals to MC is achieved. But the question is, is it equals to at least AVC? No. The moment price falls below AVC, that is the condition for shutdown actually. Since in this question price is less than AVC, firm must shut down. Okay, that is the shutdown condition, even though P equals to MC is achieved. Okay, so to operate, firm should have got a price here actually. Then you see P equals to MC is achieved, which is more than AVC. So, that means the demand is such that P equals to MC is achieved at a point which is less than AVC. Okay. Then, in moving down from the elastic segment to the inelastic segment of the monopolist demand curve, total revenue is increasing, but marginal revenue is negative, decreasing and marginal revenue is positive, decreasing and marginal revenue is negative, increasing and marginal revenue is positive. Now, if you recall once again, just now we discussed that when you have a monopolist, let us say this is Q, this is P, this is the monopolist demand, this is the monopolist MR, this is the MC, so this is equilibrium quantity, this is price, sorry, this is the point, this is price. And this portion we discussed in the context of a monopoly, that this segment of the region where the equilibrium point exists is the point where E is greater than 1. So, obviously, if that is the equilibrium, then total revenue cannot increase by moving to the inelastic region, no. If that was the case, monopolies would not have operated here. Equilibrium is here means you cannot get more than that by moving from elastic region to inelastic region. What will happen here? Again the same, the relationship MR equals to P into 1 minus 1 by E. So, when E is less than 1, that implied MR is actually less than 0. So, when you are moving from elastic region to inelastic region, then total revenue is decreasing, marginal revenue is also negative. That is the answer what we have learned. Okay. So, monopolists must operate always in the elastic region of the demand curve. By going down, you are actually reducing your total revenue, and you are operating in the, you must operate in the elastic region. So, with this we are closing our discussion today, and in our next class we will be discussing some more problems again. So, the idea is basically to give you more and more problems, so that you can get an applied perspective of the course principles of economics. So, basically in all these problems you see some of the economic theories or principles that we have learned earlier in both micro and macro modules, we are applying to understand how to solve several economic problems in real world. Thank you.